This week on the Bearded Banker podcast, how to strengthen an offer in this market. What type of market are we experiencing in Jersey? Updates on the Fed and record-breaking numbers for the economy. Stay tuned. What's up, everybody? Welcome to the Bearded Banker podcast, hosted by yours truly, Daniel Valencia, team leader and senior mortgage loan officer, NMLS number 957014. On this podcast, we discuss everything mortgages, money, and mindset. If you're listening, you may not know, but you can watch the video of this podcast on YouTube. And if you're watching, if you don't know, you can listen to this podcast on your preferred podcast platform. Either way, I appreciate you for taking the time and hope you find it valuable. And if so, you can do all the things that we know the almighty algorithm loves. But for now, just sit back, relax, and enjoy the episode. Welcome back, and thank you for joining. It is February podcast episode 18, Super Bowl weekend. Speaking of the Super Bowl, we have the 49ers and the Chiefs. I'm a Giants fan, so I don't really have a horse in the race or a dog in the fight. I don't know if I could root for the Niners. A lot of my buddies are Niners fans, so best of luck to them. The Chiefs, I like the Chiefs. The Chiefs are kind of the new bad guys, the new Patriots, I think, because they've been winning and everything with Mahomes and Travis Kelce. So we'll see. Should be a good game tomorrow. But episode 18, we're getting into the swing of things. My goal is episode 21. I read somewhere, if you listen back earlier in the podcast, that majority of podcasts, I think like 90%, 99% don't make it to episode 21. So that was the original goal, and we're almost there. What we're talking about this week, how to strengthen an offer in this market. What type of market are we experiencing in Jersey, specifically North Jersey? Central and South Jersey, very similar, and the nation overall as a whole. But obviously, we know this market best. Updates on the Fed. We have some comments from Powell we're going to go over and some record-breaking numbers for the economy. So let's jump right in. So another way to strengthen an offer. A few episodes back, maybe 2 episodes ago, maybe last episode, we spoke about how to strengthen an offer so you can increase your chances of getting an accepted offer in this market because it's been so crazy, which we'll talk about next. And this actually comes from a scenario we had with one of our team members who's actually a hybrid agent. So she is licensed as a loan officer and as a real estate agent. Susie, shout out to you if you're listening. Has a client that is competing for a $1.5 million property, and we had to structure the pre-approval and the offer accordingly. Now, obviously, they want to know how they can strengthen their offer, right, to make it as attractive as possible. And there's a couple things we did that we spoke about last week as far as the guaranteed pre-approval, waiving things like appraisal contingencies, waiving inspections, I believe, just for environmental and structural things, right? So basically, we're not going to be nitpicky with the inspection. A lot of times what happens, if you put yourself in the seller's shoes, someone makes an offer, you accept it, then they do an inspection, and then they'll rip apart the inspection and ask for credits to try to get the price down or try to get some money back after you accepted an offer. And a lot of times buyers and agents will do that just to get an offer accepted and then say, well, when the inspection comes back, we'll kind of work with it and see if we can nitpick a little bit and get some money back. Due to the market and the competition, we've been seeing a lot more inspection waivers or limiting the inspection only to environmental and structural. So in this particular scenario, again, I think it started at 1.3 or 1.4 million, eventually got up to 1.45, 1.5, and our borrowers were competing with a cash offer. So some of the things when you're competing with any offer like we just went over, right, you're going to waive appraisal contingencies, waive inspection contingencies. Hopefully you don't have to sell a house to buy the new one, which is another scenario we'll go over in a second where, if you own another property, is it possible to purchase the new property without having to sell this one? Because what happens is, again, put yourselves in the shoes of the seller. If you're looking to sell your house and the buyer for the offer you accepted has to sell a house too, if something falls through with that, then it can affect your purchase. And if you're buying another house, it affects your deal too. So it's just a chain of events. So a lot of times sellers are looking for offers with as little or no contingencies as possible. So they were competing against a cash offer, and one of the things they called about through their realtor and us working together as a team was providing a non-refundable deposit. So basically, they wanted to strengthen their offer by saying, look, we're going to give a deposit, a nice big chunk of money down towards our down payment, and we're actually going to make it non-refundable, just to give the sellers even more peace of mind, especially because they're competing with the cash offer, right? So if you're doing a $1.4 million purchase and you're putting down 20-30%, your loan's still around $1 million, something like that, and you're going to put down 20, 30, $50,000 as just a deposit, good faith deposit, earnest money deposit it's called. That's also what people, when you hear on the shows, they're referring to opening escrow. That's kind of what they're talking about, right? Some money being transferred into an escrow account as part of the deal. That's a sign of good faith and that they actually have a deal. And they called and said, we want to offer this non-refundable deposit. Basically, how strong is this pre-approval, right? Because now they're coming to me as the loan officer and saying, if we do this and we're risking this money, how solid is our pre-approval? Now, that depends, obviously. Everyone's situation, everyone's case is different, right? So we have to see, one, what are the factors that make up that pre-approval? As an experienced loan officer, we're going through it to see how confident are we in this pre-approval, right? How confident do we feel that this is actually going to close? And although we issue guaranteed pre-approvals, which is basically saying if for some reason we can't issue a conditional approval or mortgage commitment on this deal based on the information we have and what we pre-approved, we'll give the sellers $2,000 basically just for the inconvenience. Now, my team and I haven't had to cut any of those checks, which we pride ourselves on. However, when your client comes to you and says, hey, we want to take this a step further and we're also going to give a deposit and we're going to say it's non-refundable, I'm going to risk $20, $30, $40, $50,000 on what you tell me right now. How do you feel? It's very hard to say, yeah, go for it, right? So my response was, I can't guarantee it, right? Because nothing is guaranteed. But looking at the file, looking at the credit history, looking at the credit score, the income, the debt to income ratios, how much money we have to work with outside of what's documented, right? Because we have your assets, maybe we have some retirement funds, maybe we have some gift funds as well from family, which is something I asked, like, hey, if we needed more money, do you have family members that can gift it to you if we need to make this happen? And we had enough wiggle room where I said, you know what, I can't say 100%, but 99.999%, I'm sure this deal is going to go through, without some unforeseen hurdles, which there's always something once we start getting into underwriting, right? The underwriters, what they do is go even beyond what we do as loan officers. So although we have a lot of experience on the front end, we have a lot of experience closing deals, things, guidelines, processes are changing every day. So what they do with background checks and income calculations and verifications of employment, the whole nine, can bring some different information into the equation, or just more concrete information, right? More accurate numbers than what we did initially. So I said, I can't guarantee it just because I have to basically cover my ass, right? I'm not going to tell you, yeah, you're good to go 100%. And if something falls through, I put my foot in my mouth and you lose out on $20, $30, $40, $50,000. Also, that I know we're going to need if this deal does fall through towards the next deal, right? So I don't really want you to risk that much. Here's what I can tell you. Here's how I feel. I feel strong. I feel confident. It's why I issued a guaranteed pre-approval, because we do also, especially as managers at the company, have the ability to not issue guaranteed pre-approvals. If we think something's a little bit more risky, we can issue a regular pre-approval instead of the guarantee. But we issued the guarantee, so I feel good about this file. What are you willing to do? So they went back and determined what they were willing to risk. I believe it was around $20,000, made the offer, and are competing with another cash offer within attorney review periods, which is basically still a time to, shake out some details. So we'll see what happens there. But if you're willing and if you can afford it, a great way to strengthen your offer is to give a non-refundable deposit. Again, what we're trying to do is communicate the solidarity of the pre-approval and the deal overall to the seller, to let them know, hey, you have nothing to worry about. If you accept this offer, it's going to close. And not only is it going to close, it's going to close with these terms on time, right? So that's what we're looking to do. So that's just one way to compete in this market. Now, speaking about the market, there was another scenario that we went through this week with a new client. Well, a past client that bought, I think, 2016, 2017, bought a 2-family home. Now it's kind of grown out of that situation, that unit, and also doesn't really want to be a landlord anymore. So sidebar here before we get into the market, a good friend of ours, Marcel, Laura, my friend, you can follow her, Nouris Marcel, on Instagram, huge following. She's a beast in the real estate game. Put up a video recently, I think this week, talking about the process of getting a home. And I didn't watch the entire, there's a whole YouTube video, but I did see the clip on Instagram. You could check out the full YouTube video. But mentioning how, real estate is something to get into, and how you can get into real estate in this country with small down payments, first-time home buyer loans, and become a real estate investor, get a multifamily, get a single family, 3%, single family, 3.5% FHA, even 5% now conventional for multifamilies, right? There's just so many ways to get into real estate. And she mentioned on one of her stories about being a landlord and dealing with these tenants and how some people don't want to deal with it, right? So Laura and I owned a property in East Rutherford, a 2-family home back in 2016, 2017, ended up selling it in 2019 because we lived in the unit. We were landlords. We didn't really enjoy being landlords, to be completely honest, right? We wanted our own space. We didn't want to deal with tenants. Nothing went wrong. We had great tenants. Everything was fine. But just sharing of the space, communicating with, using different parts of the home or what's going to go on, or having people over, whatever the case is, and then, living a certain way because you're in a 2-family home as opposed to having your own space. So she mentioned on one of her stories that, it's not for everybody. And she said, it reminds me of my friend Laura because, her and her husband sold their house because they didn't want to be a landlord. So circling back to this scenario with this client, buddy of mine, known him for a long time, helped him with his first purchase, 2-family home. Now him and his family are kind of growing out of it and looking for a single family home. And I said, you're going to keep the house and, be a landlord and rent it all out. And he said, honestly, bro, I don't really want to be a landlord. I don't want to deal with tenants. I don't want to deal with collecting the rent. Everything's been fine. I just kind of want to be done with it and move on. So it's not for everybody. And that's something that we really got to emphasize. And I try to stress to clients that are coming to me and want to buy multifamily properties or single family investments. It's a lot. It's a lot dealing with tenants, especially if you don't have property managers, which most people don't if they're dealing with 1 to 4 units or a smaller portfolio. If you have a lot of doors all in the same local area, then it could make sense to pay a property manager. But a lot of us, are just trying to get ahead and managing properties ourselves. And if you have the wrong tenant or a bad tenant, it can be a headache. You can end up in court. You can end up chasing money. And also, I put up a video a long time ago as far as what states are more landlord friendly and what states are more tenant friendly. And New Jersey tends to be a tenant friendly state, so it's a lot harder to get people out. It's a lot harder to get your money. Just some headaches to deal with there. So I'm not knocking it at all. I know a lot of people, clients, friends that own multifamily residential real estate and basically make their money, make their living on real estate. So it's definitely doable. It's just, is it for you? Are you cut out for it? Is it something you want to take on? So keep that in mind. So going back to this scenario, this client decides, I don't really want to be a landlord. However, I don't want to have a contingency on my pre-approval, right? Because we were talking about earlier, he doesn't want to say he has to sell this house in order to buy the house that he's making an offer on. So he wants to make his offer as competitive as possible. So I said, okay, what we can do is we can keep the house listed on your application as a house you're going to rent out, right? So we're going to say, okay, this 2-family house is going to be kept, retained, and it's already being rented out. One unit is already being rented out. This next unit that they're going to leave is also going to be rented out, right? So we're going to keep it on the application and use some of that income to help qualify. So now you don't have a contingency on your record. And then after you get in the home, right, you can decide what you want to do with that property. 6 months, a year, give it a shot, see if you like it, or you definitely want to get rid of it. At least you don't have a contingency on your application, or on your pre-approval, I should say. And also, the caveat to that is, can you still make a strong offer as far as a down payment if you're not selling this property? Right now, some people, they have to liquidate that property to get the equity out of it, get the cash out of it to use for the down payment on the next property. Fortunately for me and our client, my buddy, he was able to afford it, so I was able to give him this advice, right? So he said, you know what? I don't have to sell that. I can liquidate these assets. I can even get some gift money from a parent that is willing to help, so I can still make a strong offer. Now, what offer did he make? And this is going into what market are we in New Jersey. So we pre-approved him for, I think it was around $815,000 with a $250,000 down payment for a house that was listed at $779,000. Okay, so $779,000, $780,000, that was the list price. 4-bed, 2-bath house. I believe it was in Morris County, North Jersey. And he offered $815,000 with $250,000 down. Now I'm looking at this file. I'm looking at the credit score, the down payment, DTI, right? I'm like, you have a super solid file. Like, you should definitely get an offer accepted. It might not be the first one, but it's strong. And then going in above asking, right, $779,000 to $815,000 for a 4-bed, 2-bath house. Nothing crazy, right? A standard home. I think it might have been around 2,000 square feet, right? Give or take 300 either way, somewhere in that range. Nothing, no monster home. It's just what the values of the houses here are in North Jersey. I don't even know. It was updated. I don't know if it's been renovated recently, but relatively updated. So nice property. The seller countered at $900,000. So this is what you're competing with in this market, right? $900,000. So they listed at $779,000. My buddy went in at $815,000. It was best and final that day, so we were expecting to hear something quickly. I believe the next morning they came back and said, we got 21 offers, and we're countering your offer of $815,000 at $900,000. So that means that they have a bunch of offers, maybe some higher than what my client offered, maybe not with better terms as far as down payment, being at $250,000, maybe even some cash offers that were lower. A lot of times when people offer cash, they say, hey, it's straight cash, so we're not going to give you, maybe what someone with a loan is going to give you, because our offer, we can close quick, it's solid, the money's there, it's a lot more attractive, so they can kind of come in a little bit lower when you're dealing with cash, right? $900,000. So my buddy went back. I think he went in at $901 just to kind of like stick it to him. Like, fine, $900,000, here's $901. And it wasn't accepted. So that means that someone either came in with a stronger offer, maybe putting down more money, or came in higher, and the sellers and the listing agent, after reviewing all offers, decided to go with another one. So that's the kind of market you're dealing with in North Jersey and in a lot of places just around the country, right? It's still very competitive, and we always say this, when these rates come down, and they will come down, which we're going to get into next, but when these rates come down, it's going to get even more competitive. There's just not enough homes in the area, in the country, for the demand, for the amount of people that want to buy. So something to keep in mind, right? You can make a solid offer. You could be pre-approved for first-time home buyer, $400,000, $500,000, 3% down, and it's tough to get an offer accepted. So you want to put your best foot forward. That's something that we have to work on. It's not just getting you pre-approved, right? As a loan officer, I'm not just like, okay, here you go, pre-approved, 3% down, and sending out pre-approvals left and right. We're really trying to figure out how can we make the best, strongest offer possible. So when we reach out to you or when you contact us, we want to know everything. We want to know, okay, yeah, you're pre-approved. The numbers look good here. How can we strengthen this offer? What are you willing to sacrifice? Are you willing to sacrifice appraisals? What properties are you looking at? Do we think they're going to appraise? Do you have access to more funds beyond what we see here, maybe from gifts from family or other things that we can use to put more money down to strengthen this offer? Can we get rid of maybe some concessions where before we were trying to get a seller concession to cover closing costs? Can we eliminate that with more money so that your offer stands out a little bit stronger? The guaranteed pre-approval definitely helps, right? So these are all things that are going on in the industry, in the market, and people trying to get their offers accepted and put their best foot forward. And even if you have that kind of money, not a lot of people have $200,000, $300,000 to make this happen. Fortunately, I've seen a couple over the last 6 months to a year that, they've come in strong, solid. One of my best friends, Sylv, shout out to Sylv, also same kind of situation, had a huge chunk of money for a down payment and still struggled to find properties down in Central and South Jersey. I referred him to a friend of mine, business partner of mine, Kristen Sachs. Shout out to Kristen Sachs. Definitely follow her down in Central and South Jersey. She's killing it with nest seekers in Rumson, and they eventually found something, and it was a solid pre-approval. I mean, debt to income, credit score, everything amazing. Down payment was, like I said, over $200,000. Same thing with this client here, right? Over $200,000. The $1 million client we were just talking about, putting $300,000-$400,000 down, and these people are still kind of struggling. So this isn't to say that you shouldn't get in the market. You should put your toe in the water, see what's going on out there. Definitely try to get in now because, again, you're going to get the better deal now if you can find it. Start looking off market. Here's a little sidebar. I started posting recently about looking at some properties or just kind of, I always have my, pulse on what's going on and maybe might step out. Me and Laura kind of enjoy on the weekends. If we don't have anything going on, we'll go out and see some houses, go to some open houses while we're passing by on our way to a lunch or a dinner, right? And just kind of see how the market looks, what type of properties are out there. And I started posting it and actually got 1 or 2 DMs from friends that said, hey, I think you're in the market. I've seen some posts. Are you, 1, still looking? And 2, my neighbor or my friend or family has a property they're looking to sell. They want to do it off market if they can, so they don't have to deal with all the headache of open houses and having a lot of people in their home, whatever the case is, whatever their personal reasons are for not wanting to do it listed, and they want to try to sell it off market. Are you interested? So now you're putting out that energy and things are coming where you can snatch something up off market with a solid, pre-approval, solid offer. So this is what's going on in the market. Again, you have to put your best foot forward. We're going to try to structure the best possible pre-approval for you so you can make the best offer. We want to talk to your realtor. If they're not a hybrid agent that's doing both, like some of our agents, then we definitely want to talk to your realtor and figure out how we can structure these transactions, right? And structure these offers to get you something soon and solid, right? We don't want to put you over budget, but we just want to see what things we can play with here to make a nice, strong offer. So let's jump into some economic data and updates. Jerome Powell addressed the press on Monday. He downplayed the chances that the Fed would cut rates in March, and the market went up a little bit. So why did that happen, and what did he say? So basically, after the Fed meeting last week, he spoke to the media on Monday and answered some more questions or gave a little bit more information on where they're at, and basically downplayed the chances that the rate cuts would come in March. And like I've been saying over the last couple podcasts, I have seen some reports that said as early as March the Fed would start cutting rates. So that's kind of been built into the suspense, built into the expectations of the market, and that gets priced into the stock market and rates and bonds and everything. So when Powell comes out and says, yeah, it's probably not going to happen, that actually changes some of the feeling, some of the sentiment in the market, right? So now they feel like, okay, so if rates aren't gonna come down soon, then rates are gonna go up for the meantime, right? Because the market is always anticipating what's gonna happen. They're trying to be first, right? To buy low, sell high, kind of the same idea, right? They want to be ahead of the curve. So when the idea was that rates might be cut in March, people are like, okay, and you'll see rates actually start coming down in the mortgage market because of what's anticipated to happen. Even though it hasn't happened yet, some of those rates will start to come down. Now, when Jerome Powell gets on TV and says, it's probably not going to happen in March, then rates kind of go back up. So we've seen some higher rates over the last week than over, maybe the first month of January. Over the last week, they were slightly higher because of these comments. We're still expecting them to come down, but probably more towards the middle and end of the year, kind of as expected. Again, these reports that said March were pretty aggressive, and it was possible. But those comments, and all he did was make some comments. This is not the determination of the Fed. It's still possible that they could change something in their March meeting and decide to cut. It's just him expressing himself changes the market. And it's crazy how all that, affects what we do, affects the market, affects people's investments, 401ks, interest rates, credit card rates, and obviously mortgage rates, right? So that's kind of what the update was from Jerome Powell this week. We also had jobless claims, aka unemployment, that came in a little bit lower than expected, which means that we still have a healthy job market, right? So over these last couple of weeks, we've been talking about the job market and how unemployment affects the sentiment and what the Fed is looking to do, right? If unemployment is high, that means that people can't spend because they're losing their jobs, so that inflation should come down, and that's one of the tools the Fed uses to determine what they're going to do. So the expectations were one number of unemployment for this week. They actually came in a little bit lower, which still signals a healthy job market, which is also probably or definitely why the Fed and Jerome Powell made the comments that, hey, we're not looking to cut yet because things are still, job market's still strong. We're not seeing the decrease in inflation that we necessarily want to see yet. So we're just going to hold steady before we start cutting. So that makes sense. And then lastly here, before we kind of wrap up for this week, some record-breaking numbers for the economy here. The S&P 500 closed above 5,000 points for the first time ever. So I saw a post via, I believe it was Earn Your Leisure, that said since 1952, the market has never had a down year when an incumbent president is running because the White House, right, that party is doing what they can to buy some votes. And that's basically looking to keep market and returns high because that, in a way, indirectly makes people feel like the current president is making them money. Right, so because we're in an election year, because an incumbent basically means the sitting president, right? So Biden is looking to run again or putting his hat in the ring. The White House is going to do what they can, and when they say the White House, they just mean the government on his side of the aisle are looking to do what they can to keep those returns high. So we're seeing a good year for the stock market. Now, typically, when stock prices go up, when the market is healthy, rates go up as well, right? Because it's a sign that the market is healthy. Rates tend to go up and kind of follow that. Returns and yields go up, things like that. So we kind of see that kind of track. But in this case, because rates were increased so rapidly last year, when we see that strength in the stock market or strength in the economy overall, the Fed is still looking to see what's going on in the job market and with inflation to see if we can actually cut rates. So again, we're in this weird kind of time where things aren't as correlated as usual. They still are, but not as much as usual, right? We've seen some things over the last year where if you look at the 10-year treasury yield, which is something that tracks similarly to mortgage rates, right? When the 10-year yield is up, rates are usually up. When the 10-year yield is down, rates are usually down. And that's because most mortgages, majority average, American keeps their mortgage for about 7 to 10 years. So the 10-year treasury yield is kind of what the correlation is for mortgage rates, right? Because most people aren't going to keep the same mortgage for 30 years. That doesn't mean they won't keep the house. It means either they're going to pay off the mortgage, refinance the mortgage, or sell and get another home, things like that. They just do things with their mortgage usually within 10 years. So that's how it tracks. Now, usually that yield and mortgage rates are very correlated. We've seen over the last year or two, especially with the pandemic, that it hasn't been as related as usual. It's definitely gotten back to more correlated, but there were some moments there where it just wasn't really reacting the way it should because there was so much uncertainty in the economy, especially with real estate and mortgages overall, that it wasn't tracking exactly. But we're kind of back to that. And the S&P is hitting record-breaking numbers, which still shows that there's a lot of money in the system. People are still making money. People are still working and generating income and spending money, right? Money's moving around. So we do have a pretty solid market, pretty solid job market and people are working and making money. Whether that means that they're taking on additional work or whatever they have to do to make ends meet or maintain their lifestyle, we don't know, because that's definitely a variable there. But that's how it looks. Soft landing looks inevitable, and rates look like they're not going to be cut yet, maybe more towards the end of the year with these healthy numbers. But inflation is coming down, so that's a good point there. So that's it for this week. Just a quick update, some tips there. I hope you all have a great week. I hope you enjoy the Super Bowl if you're watching, and we will touch base again next week. But before we go, the goal in life is to be mortgage free, control your emotions, have integrity. If you want to use my likeness, I need equity. And if you're really trying to win, you need to bet with me. Take care.